Motilal Oswal is primarily a very, very good way to play the financialization of savings theme and the growth of capital markets in India, because they are a vertically integrated capital markets player. They have a good franchise in asset management, wealth management, broking, investment banking, alternatives, financial distribution, etc. All these businesses are capitalized. So unlike what you see in some of the developed market countries, they don't operate in any of the businesses which are balance sheet heavy. So these are all mostly capital light businesses that they operate in. They have a wonderful track record over a 30-year period. But even if you look at over the last 10 years, it's their book value per share in USD terms has grown at 21% plus. I think in INR terms would be 25% or something. They've had a 10x scale up in all forms of operating metrics that you would look at: revenues, asset under management, profits, etc. You can see that this is a capital efficient business model by seeing that insiders continue to own over 75% of this firm, which has currently almost like a 4.5 billion market cap. Using the dividends from the firm, the insiders also have a $1 billion personal investment portfolio. So this business has continuously generated free cash flow since inception. It hasn't required capital. They raised capital at IPO, and there's no other capital raise at all, and they've had two share buybacks. So that's the reason insiders continue to own a large percent of the business. The core investment thesis here is that the business has undergone a meaningful change in the quality of earnings. Generally, broking and transaction based businesses get a lower multiple, and wealth and asset management businesses, which have higher recurring revenues and higher growth rates, tend to get higher multiples. In Motilal's case, I think the higher growth segments, wealth and asset, have moved from 20% of the profits to 50% plus now, and on track to move to 70 to 80% of the profits in the next 2 to 3 years. So that itself would need a valuation re-rating. The stock, after the current correction, is starting to trade at very attractive valuations. It's trading at less than 14 times operating profit after tax on trailing basis, and 3 times book value. They use this free cash, and then now they're building a treasury segment for the last 15 years. So the balance sheet is strong. Yeah. I usually generally don't speak too much about the macro opportunity, but in this case, since this is a capital market theme and the current capital market cycle becomes much more relevant to the investment thesis, I will speak a little bit more on the macro story and macro India story, and also the opportunity within the capital market space. As you can see in this page, you can do your own numbers, have a base case, bear case, all. But the broader point is that India is growing. You can make whether it's growing at 7% or 9% or 8%, you can make a change. But India has structural reasons on why it should grow at above 7% for the next 2 decades. And if that happens, and considering the current Indian savings rate and the trend, we are speaking about almost 47 trillion USD of cumulative savings over the next 15 years. And typically, as per capita income increases, the amount of savings that goes into equities or capital markets increase. But even if you hold on to the current rate of 7 to 8% of incremental savings into equities, we are speaking about a 3 4 trillion USD coming into the capital markets over the next 15 years, and that's a huge TAM, and that's the exact TAM to which Motilal Oswal is targeting. Next slide, please. Yeah, you can look at different metrics to see how underpenetrated Indian equities market is. But one thing is extremely important to understand is that the regulations in India for from a capital market ecosystem development has been very strong. That's the reason you're seeing a lot of companies continue to be listed here. So unlike what you see in the west of where the number of publicly listed companies have been peaking, in India the number of publicly listed companies has been growing a lot over the last 10, 20 years. And the savings have been moving from traditional bank deposits and gold and real estate into more and more financial products. It could be insurance, pension, mutual funds, and that's a secular trend that we have seen over the last 20, 30 years. And we are still at still a reasonably early age, because if you see what's happened in the developed world, 70 to 80% of the savings move into capital markets, and capital markets in the sense including the debt markets, and only 20, 30% in bank deposits. It's the reverse in India currently, but I think the trend is pretty clear. And the capital market ecosystem is fully digital, it's fully transparent, and the infrastructure is actually, because we started from scratch, the infrastructure is actually better than what you see in other markets in terms of the depositories being public infrastructures, and the brokers being very capitalized, and so on and so forth. So I think the risk in the ecosystem is low and the growth is set.